The anticipation of this reopening, it is slowly being priced in.
What's happening in China and reopening is a wild card, and we know that the Fed has very limited tools to deal with commodity price inflation.
I do think supply side forces are improving. You have China reopening, but demand side really hasn't taken that hit yet.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
10 a.m. in London, 5 a.m. in New York, 6 p.m. in Hong Kong. Our top stories today. The US joins a growing list of countries requiring Chinese travelers to take COVID tests. The EU's Health Security Committee will also meet today to discuss a collective European response. US futures, though, turning positive, but European airline stocks and crude both slump as investors weigh COVID returning as a risk for 2023. And more job cuts are coming at Goldman Sachs. CEO David Solomon says the latest layoff plan will be unveiled in a matter of weeks. Welcome to Bloomberg Surveillance, the early edition. I'm Guy Johnson in London, Kriti Gupta and Kailey Leinz in New York. Anna Edwards is off today. Matt Miller will be co-hosting Surveillance in the next hour with Kailey. Kailey, let's talk about the China story. It remains front and center for markets.
It does, and it's really weighing on risk sentiment around the world. The idea that cases are surging there and potentially could trickle through to other areas of the world as Chinese travelers are free to move about the globe once again. That is why you are seeing countries like Italy and the U.S. imposing new requirements, testing requirements on travelers coming from China. But it does really raise concern about the trajectory of the virus that we all had been trying to put past us. As a result, stocks were down broadly in Asia. The MSCI Asia Pacific Index as a whole down about 0.6%, but real underperformance was coming from technology stocks in particular. The Hang Seng Tech Index down by about 2.5%. And of course, the other consideration in the China story is whether or not it is going to meaningfully refuel global inflation and pick up demand for commodities and as a result weigh those prices. So that has been bringing bond yields up around the world, including in Japan. The BOJ, of course, trying to push back against that, maintain their newly higher yield curve control cap. But what's interesting is their bond buying, unscheduled bond buying that they conducted for a second day was only between maturities of 2, 5, and 10 years. So at the longer end of the curve, you did see yields moving higher. The 20-year yield in Japan up about 5 basis points to 1.32%. That is the highest going back to October 2014. What is interesting, though, is that even though the Bank of Japan is still trying to be dovish, the Japanese yen is stronger on the day. That could be a bit of a haven bid, and broadly, it is a weaker dollar story. But dollar yen today trading at 133.64, Kriti.
Well, Kailey, a little bit of a different story stateside, at least in early futures trading. Take a look at this. S&P 500 futures up about 0.3%. So you are seeing a little bit more buying in the U.S. session than you are perhaps in other regions of the world. But remember, I think this is also going to feed into the story that if you are worried about that COVID risk, if you are worried about some sort of repeat of 2020 or even 2021, these kind of new variants and potentially the Chinese kind of response, one of the big trades that has worked in the past is this flight to U.S. assets. That's exactly what you're seeing this morning with, I said, futures up, but also a bit into treasuries as well. You're looking at 385 on the 10-year yield. It's only down about 2 basis points, but still enough, just given it is a very light volume week, thin liquidity, our favorite buzzwords for the holiday. That's important to keep in mind, but remember, it's coming at the same time that you do have that commodity response as well, a slightly lower, and that by 2%. And that actually is, in a volatility-induced context, a normal margin of a move for NYMEX crude, now trading at a 77 handle. One of the fears here is that if you start to see the COVID cases spread more and more, specifically in Europe, does the NYMEX and Brent crude marks drop into the 60s handle? And that's going to be a trade that's going to burn a lot of people that are betting on higher oil prices in 2023. And of course, Bitcoin really following the story that you are seeing in futures. Remember, yesterday it was a little bit suppressed. So now I would call Bitcoin a little bit of a bounce back story, Guy, up about 0.4%.
I want to come back to that crude story, actually, because it is having an impact here in Europe. London is underperforming a little bit. You've got names like BP and Shell on the downside. Interesting that we did see that technology story in Asia, but actually technology is the best performing sector here in Europe. So the stock 600, the aggregate picture, absolutely flat, but it's actually popped over the last half hour. We're back just in positive territory, but it's been quite a rise as we've come through the initial hour or so of trading. What you are seeing, though, is anything kind of travel related under pressure. it's a knee-jerk reaction as we start to see some of these restrictions potentially be putting into place. The US, Italy, Taiwan, India, etc. You are seeing the airline stocks reacting to that. So Lufthansa, for instance, is down by over 4% today. And then you come back to that Brent crude story. Brent now trading 81.84. We're down by nearly 2%. That's feeding back into the equities, as I say. Technology at the top, but energy under pressure. That is why London is underperforming, Kailey.
Okay, so really it all comes down to that China story. So let's get more on that now, Guy. COVID cases are surging domestically with concerns mounting over the risk of new variants emerging. The outbreak, as Guy mentioned, has prompted a growing list of nations to require COVID tests for travelers from China. Let's get the latest on the ground now. Bloomberg's Alan Wan in Shanghai is joining us for the regional reaction. So, Alan, give us the China take on what the rest of the world is doing to its citizens or requiring of its citizens.
Well, what you were just saying earlier about the U.S. and Italy now imposing these new testing requirements on Chinese passengers, it's actually a bit of a. I mean, I think folks in China are by and large, they're upset a little bit, but they accept it. The U.S. testing requirements actually aren't very different from what China has been doing to the rest of the world over the past 3 years. And what these requirements are, basically, is just like I said, is the negative test results upon arrival. But in lieu of that, if passengers can show that they've recovered or that they tested positive more than 10 days earlier, then that'll be acceptable. And also, the U.S. is also applying this to all passengers out of China, regardless of nationality or vaccination status. The reason U.S. health officials are, they do know what they're concerned about is the fact that China's lack of transparency over COVID data. What they're saying is that the rapid sudden increase of infections over a short period of time could lead to new variants. But for China's part, it's saying that if any new variants emerge, that it will inform the World Health Organization, and a global consortium tracking the epidemic has said that so far there haven't been any major significant variants emerging out of China, and that what we've seen so far here in China is basically what we're seeing in the rest of the world.
Alan, let's talk about numbers here. How many people are actually infected in China right now? Are we getting anywhere near the peak? What kind of information do we have on that front? Okay.
Well, China's CDC said today that the outbreaks may be peaking in Beijing, in Tianjin, and in Chengdu, but it's still pretty serious right here in Shanghai, as well as in Chongqing, and it's spreading fast in other provinces such as Henan and Jilin up in the north. And also the CDC said that it's probably going to get worse in the weeks ahead because of the Chinese Lunar New Year holiday. That's in terms of the numbers, I would say that accurate numbers are hard to come by. What we do know is the NHC has said that about 18% of the population, about 248 million people, may have already been infected in the first 20 days of December. And then there's Airfinity as well. This London research firm said that about 1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
These are incredible numbers. Alan, as ever, thank you for the update. We really appreciate it. Bloomberg's Alan Wan joining us from Shanghai. Let's talk about the European response in a little bit more detail. Italy will begin testing all arrivals from China for COVID and is now urging other EU countries to do the same. This comes after almost half of the passengers on 2 flights to Milan from China were found to have the virus. Tommaso Edpart, our Milan bureau chief, joins us now for more. Tommaso, why has Rome decided to move on this without the rest of the EU?
It looks like, Italy is again at the center of the COVID pandemic. The Milan region official decided a couple of days ago to test passengers arriving from China flight to see which is effectively the rate of infection. And they found out yesterday that about 50% of the first 210 passengers tested had COVID. So this was an alarming sign, and the Italian health minister rapidly decided to then impose mandatory testing to all the passengers arriving from China, and is asking the rest of EU countries to do the same as a precaution. As we are speaking, Italian is sequencing some samples of the passengers to see if there is any new variant. The health minister yesterday night said we're not expecting a new variant, so we are not concerned in the short term. And obviously, this is a key indication that also investors are waiting to hear. If there are no new variants, then vaccine that we have here, over 80% of the population is vaccinated in Italy, will be working. So that's almost fine. But if there are new variants, then that would be a different scenario. At the moment, the health minister say we are not worried about it. But let's see. Let's wait for the numbers to come.
Well, Tommaso, as you mentioned, Italy would like the rest of Europe to join them in this policy. What is the likelihood that the EU will do so?
So Italy formally sent a letter to the European Commission, said we can't be alone in this. We just found, an alarming number. We know in Brussels they are meeting today to make a decision. We'll see if the European Commission will decide to test all the passengers coming to China. This has not been decided yet. I think that the key point here is, again, the result of the sequencing done by Italian authorities. We're expecting it to arrive today.
Tommaso, great stuff. Thank you very much indeed for the update. Tommaso Ebhardt, Bloomberg Milan Bureau Chief, thank you very much indeed. Let's turn to the other story you mentioned at the top of the hour. Goldman Sachs CEO David Solomon has warned that job cuts are on the way. In his traditional year-end message to staff, Solomon said that the firm is working on a new round of reductions and that they are likely to be unveiled within a matter of weeks. Bloomberg's Danny Berger joins me now on set. Danny, what do we know about the size and scale?
Well, so earlier in the month, we learned to be about 8% of the workforce. That's about 4,000 people. So a hefty amount, more than usual for what Goldman usually lays off for job cuts, about twice as much. So this letter really just confirming the timeline, I suppose. He didn't say anything about the numbers in this letter itself, not a very cheery year-end letter, I might add, basically saying that this will likely happen in the second half of January. He also blamed the overall macro environment, so tighter monetary conditions, slowing the economy, not really talking about their foray into consumer banking, which a lot of folks have blamed for overspending and the need to pull back, because Goldman did just finish up its second best year on record. So that on the surface doesn't explain why they'd be cutting so many jobs. It really is this profitability question.
Well, Danny, Goldman, it's not a surprise, sets the standard when it comes to industry hiring, sets the standard when it comes to salary. To what extent are they setting the standard for these layoffs for the rest of Wall Street?
Well, at least for the moment, Critty, they are an outlier. Not an outlier in letting folks go. That is starting to happen throughout the industry. But Goldman is certainly doing steeper cuts than most. Again, it probably goes back to the fact that they had been spending and hiring a lot in a division which they're now trimming back on. For example, I was talking to Frederic Udea earlier in the month, the outgoing CEO of SocGen, who told me that they're not firing anyone additional from what they already had planned because Europe is starting from a better position. The outlier alongside Goldman Sachs might be Credit Suisse. Of course, they're doing a wide restructuring, so that probably explains that. But just to give you some of the numbers that Bloomberg has learned from other banks that, again, fall far behind Goldman. Barclays, they're going to let go about 200 people, according to people familiar. Morgan Stanley, 1,600, and Citi, just dozens, Kailey.
All right, I am sure we were going to get more details on this in the next couple of weeks once big banks start reporting results and the CEOs have to take questions on the analyst calls. Bloomberg's Danny Berger, thank you so much. Now, aside from Goldman, let's take a look at some other stock stories to watch this morning and those moving in pre-market trading. One I want to note is Tesla, because a rebound underway potentially for a second day. Remember, as of Tuesday, the stock was in the middle of its longest losing streak since 2018, but we saw a 3% rebound yesterday as some dip buyers came in, and that is continuing this morning. The stock up about 3.7% at this point, aided today by Adam Jonas over at Morgan Stanley, who published a note and said essentially the derating of the stock has created a buying opportunity. So maybe a lot of people are taking advantage of that buy the dip opportunity today. And it's not just Tesla in the big, large cap space of technology that is moving higher. You actually have a rebound underway for some of those other mega caps as well. Amazon, Apple, Nvidia, all up in the ballpark of between 0.6 and 1.2% at this point. And remember, they're all trying to recover some of what have been very, very steep losses for players of this size over the course of 2022. One group of stocks moved to the downside, though, in early hours. Really, the largest group of underperformers is energy. That has everything to do with the declines in oil that you and Creedy were talking about, Guy. ExxonMobil and Chevron each down about 1 percentage point before the bell.
Kailey, coming up, we're going to have Patrick Armstrong join us. He is not convinced that we are going to see a bounce back in those technology stocks in 2023. He's the CIO over at Plurimi. We'll get his take. Keshav Lohiya, CEO of Oilytics, is going to be joining us to talk about that crude trade that Kailey was just mentioning. And it's not over yet for Southwest. That seems to be the story coming out of Cowen. We will get a take there on where this particular airline goes next. I think a lot of people trying to find out answers to this. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Creedy Gupta in New York and Guy Johnson in London. Anna Edwards is off this week, and Matt Miller will be joining me and Lisa Abramowitz on Surveillance later on this morning. And we will likely continue to talk about Southwest. Analysts have long warned about the airline's outdated technology that has left thousands of passengers across the U.S. stranded this week. I spoke to Cowen analyst Helene Becker yesterday on Surveillance about that situation and where Southwest goes from here.
Everybody else is pretty much within what I would call their normal course of doing business. The cancellations are relatively low. Southwest accounted for more than 80% of all cancels yesterday. And for them, they're just behind the curve here, and they probably won't get caught up until the weekend at the earliest.
Well, and we have seen modeling from analysts over at Citi that talks about a 3 to 5% earnings hit for the fourth quarter. But I'm wondering what kind of signal this is on the longer term operational health of Southwest beyond just what is ongoing currently. If something like this could happen at this scale for this long, does that just mean they're ill-equipped to handle weather events like this? I mean, what went wrong here that could go wrong again?
Yeah, they had a confluence of a lot of events. So you had the weather, and it moved across country, hitting Denver and Chicago particularly hard. United is in both of those locations, didn't get hit quite as hard, but still impacted. For Southwest, though, I think at Midway, there was a lack of de-icing fluid. Then they had an issue in San Diego with fog. They had ice in Dallas. So everywhere they were, they had weather. And the worst of it is their systems are just not equipped to handle it. Historically, Southwest underinvested in IT, in technology, and this has come back in the past to hurt them. They were investing aggressively this year. That was one of the catalysts we thought, for the shares later this year, as the new scheduling system for employees was coming up. But one of the issues we saw yesterday was an aircraft with a bunch of flight attendants deadheading to a city. But the crew working the plane was short a flight attendant. And according to the pilot on board, any one of those other flight attendants offered to work the flight, but they couldn't get through to scheduling to say, hey, we're here, we'll take it. And so Southwest canceled the flight. They're doing what should be automated by hand. When you have 6,000 flights a day, and you probably shouldn't, you should probably have 2/3 of that. It's not that they don't have enough people, it's that they don't know where their people are.
So essentially, Creedy, her thesis is it's a broken system.
It's interesting that it's coming as a broken system, even though Southwest was one of the receivers, I should say, of all that pandemic aid. And it really begs the question, what did they do with it? At the same time that a lot of other airlines like Delta, American, for example, they use that pandemic aid to amp up their systems, pay their staff. And now they're the ones that are actually putting price caps on some of their tickets, Guy.
Yeah, I have to say that you talk to people inside this industry, they tell you horror stories about what technology many of these airlines, particularly the legacy carriers, are actually running, Kailey.
Yeah, it'll be interesting to see how they invest in technology. And if they are doing so, does that mean airline tickets are never going to get cheaper? That's what I'm praying for in 2023. Coming up, we'll have more of the roundup of some stories around the world you need to know. This is Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. Russia is ruling out peace talks with Ukraine and says it won't give up, despite setbacks on the battlefield. Foreign Minister Sergei Lavrov also told a state-run news service that Kremlin will not discuss Ukraine's demands that it withdraw from occupied lands and pay reparations. The war is now in its 11th month. And the Bank of Japan is fighting back against traders, betting it will relax its yield curve control policy even more. The central bank announced 2 additional rounds of unscheduled bond purchase operations. The BOJ doubled the ceiling for 10-year yields earlier this month. And ExxonMobil is suing the European Union over a windfall profits tax on oil companies. Exxon argues that the EU does not have legal authority to impose the tax. It's designed to raise billions to bring down consumer energy costs. Exxon recently told investors that windfall taxes could cost the company at least $2 billion through the end of the year. It was one of the more significant disruptions to Twitter since Elon Musk took over the service. The platform has restored service hours after thousands of users worldwide reported glitches and other issues. Musk said Twitter had rolled out changes to its server architecture. Coming up on the show, Patrick Armstrong, CIO at Plurimi Wealth, joins us. He's going to talk to us about markets, about commodities, about everything you need to know for 2023. That conversation next. This is Bloomberg.
This is Bloomberg Surveillance, the early edition, and this is what you need to know. The US joins a growing list of countries requiring Chinese travelers to take COVID tests. The EU's Health Security Committee meeting today to discuss a collective European response. US futures turn positive, but European airline stocks and crude both slump as investors weigh COVID returning as a risk in 2023. And more job cuts are coming at Goldman Sachs. CEO David Solomon says the latest layoff plan will be unveiled in a matter of weeks. I'm Guy Johnson in London. Kriti Gupta and Kailey Leinz are both in New York. Anna is off today. Matt Miller will be co-hosting Surveillance with Kailey in the next hour. Kriti, let's talk about the setup for US markets. We know volume is going to be light, but China is certainly complicating things.
It has a little bit. It's a little bit of deja vu, I would argue. Remember, of course, we're all expecting this to be a light trading week, to your point, that is going to somehow result in that Santa rally, green on the screen for the last 5 trading days of the year. But I think there might be a fundamental reason to this as well, outside of just that dynamic. The idea here simply that if you are worried about COVID, if you are worried about some sort of spread, some sort of repeat of other variants, or even 2020 situation, now that China is actually allowing some of its overseas travelers to leave and have perhaps a lower restrictions as it exits and re-enters the country, that is going to create a defensive bid into the market. And traditionally, from a global perspective, that defensive bid results in a bid into American assets. So the futures are up about 0.3%. I wonder how much of that is coming from that early positioning we're going to see in 2023. But you're also seeing a bid into the Treasury market as well. 386 on the 10-year yield, only down about 2 basis points when you look at the yield, but really still significant when it comes to kind of the nothing trade that we've seen for the majority of this week. What I also think is interesting is this divergence you are seeing between the commodity space and the stock space. The idea here that crude is actually down about just shy of 2%. Once again, the idea of what might a wider spread of COVID actually do to demand relative to that defensive bid you may or may not be seeing in the futures trade. And of course, Bitcoin kind of taking its cue from, I would say, the cross-asset picture here. Bitcoin up about 0.4%. Kailey.
Well, Kriti, I want to come back to the oil story because that is filtering through some individual movers in pre-market trading. Yes, broadly, most stocks are higher, but the group sitting that out is energy stocks, given that oil prices are down. So the likes of Devon Energy, Marathon Oil, Occidental Petroleum, each down about 1% or more before the bell. But one stock that has been underperforming dramatically as of late, but is actually outperforming today, is Tesla. The stock is up about 3.7% in pre-market trading today after a 3% gain in the Wednesday session that saw it snap its longest losing streak since 2018. You now have Adam Jonas over at Morgan Stanley saying that the derating of the stock has created an opportunity, and it does look like that dip buying has come in. But remember, for Tesla, even if it's been a positive day, possibly a positive second day guide, this stock is still on pace for its worst month, quarter, and year on record. It has been absolutely brutal.
Yeah, we're going to talk tech stocks in just a minute with Patrick Armstrong. Before we do that, let's talk, Kailey, about what is happening with these European markets. Basically flat, but well off their lows, which is significant. Travel stocks, though, are underperforming. Lufthansa down by over 4% right now. The European Union is meeting today to discuss whether or not we are going to be seeing the whole of the EU following Italy and imposing COVID checks on arriving passengers from China. Brent crude down by 1.81%. Therefore, you've got oil stocks lower as well. That means you're getting a little bit of underperformance, Critty, coming out of London.
Certainly something we're going to be keeping our eye on, especially going into 2023, where that inflationary trade may not be the one to bet on going into the new year. Let's get a little bit more perspective here. Joining us now is Patrick Armstrong, CIO at Plurimi Wealth. Patrick, thank you as always for joining us during this holiday week. We certainly appreciate it. I want to start with the core of what was at the market sell-off of 2022, which seemed to be the Federal Reserve. I'm curious, though, in 2023, how Fed cuts really plays into the picture. There seems to be a lot of doubt that the market is mispricing this, but why, if this is something that the Fed has relied on for the past 2 decades? What do you think?
Yeah, our view is the Fed hikes in the first couple of months or the first 3 months of 2023, and then it's probably sitting on its hands for the rest of the year. I don't think you'll get the third 25 basis point hike in, probably because the economy is flirting with a recession or just about to roll into a recession. But the market's pricing cuts in the second half of next year. I don't think that's going to happen. All the Fed rhetoric, it may change, it has changed on a dime in the past, is that the focus is inflation. It's not about defending the job market. As we do get into a recession, the job numbers are going to start to look weaker, but I don't think the pivot will happen. I think it'll be more of the Fed sitting on its hands rather than starting to cut rates in the second half.
Okay, so does that mean that the expectation, Patrick, that it's going to be a pretty brutal first half, but things will get better in the second half is misplaced? I mean, what kind of returns can we realistically expect next year if you're assuming that the Fed's going to stay strong?
So the multiple compression that's really been the story of 2022, I don't think that's going to be a big factor in 2023. The stocks that have really seen their share prices decimated this year, I don't think there's a quick recovery for them next year because they're dependent on liquidity, they're dependent on stimulus, and dependent on investors dreaming. And I think next year it's going to be more about surviving, finding companies that can defend their profit margins, rather than really putting capital to work in dream stocks that don't have a path to profitability, have earnings a decade off. And when liquidity is abundant, those stocks thrive. When you've got an interest rate that's higher than inflation and quantitative tightening, I don't think we get a rebound in those stocks. But overall, I think you're going to get modest returns from equities. Companies that are generating cash flow today, that are buying back shares, paying dividend yields, and have the ability to defend their margins in a probably tough consumer environment. I think those kind of stocks will go up next year.
Well, Patrick, what I'm essentially hearing is you're delineating within the growth space. Those that don't have earnings, that are not profitable, are going to continue to fare poorly, perhaps. What about the ones that do? You would maybe consider more quality within technology, large caps like Apple, Amazon, and yes, Tesla, as we've been discussing, that have gotten absolutely decimated this year. What happens to those kind of names?
I own Apple, I own Alphabet, I'm short Amazon. And I wouldn't put Tesla in that group. It still doesn't generate significant earnings. It swings from profits to losses, and it's based on credits it's getting from some of its competitors. So I've been wrong on Apple. I've been wrong on Alphabet. My view this year was the most expensive stocks would sell off a lot, but those quality companies would probably be able to weather it. But their multiples have fallen with the market. I still like them. Apple's got issues with consumers, but the consumers that are buying Apple products probably are in the upper end of the consumer segment, that mass market is Apple, but the lower end of mass market isn't buying Apple. And I think that's the part of the consumer segment that's really going to be hit by higher mortgage costs, energy prices, food prices. So I still like Apple. Alphabet, driven by advertising. I like Amazon, still doesn't have the earnings. All of its earnings are coming from its cloud. its retail, it's still not been able to price its goods at a level where it can really make profit yet. And I don't think that changes in 2023.
Patrick, good morning. It's Guy. How big a wild card is China in 2023?
It's very much a wild card's the right word. It's almost unpredictable the way they've put their zero COVID in place and kept with it for so long, and then pretty much turned on a dime to changing policy over the last 4 weeks, where they're almost ignoring COVID, it seems, right now. I suspect this plan is positive for the economy, positive for markets next year. But you also have other risks that aren't just COVID, with Taiwan, other geopolitical risks, its ties with Russia, how that develops. So it's something that looks cheap for equities. There's a lot of risks with it. I'm actually staying away from Chinese stocks just because I've seen what's happened to Russian stocks. And you call it a wild card. What happens with Taiwan is going to determine if those companies have any value to Western investors.
Yeah, important to consider the geopolitical risk as well here. Patrick Armstrong of Plurimi Wealth, thank you so much for joining us. And coming up, we'll continue the China story through the lens of the commodity complex. Oil's price today getting hit by COVID fears. But could we see demand coming back in the more medium term? We'll discuss with the CEO of Oilytics next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Best Western CEO Larry Kozelek. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Guy Johnson in London. Anna Edwards is off today. Matt Miller gearing up to join me on Surveillance with Lisa Abramowitz in just about 20 minutes' time. Let's talk about commodities now. Oil is extending losses this morning on concerns that China's rapid dismantling of its COVID-0 policy could lead to a surge in cases across the world. Crude is heading for the first back-to-back quarterly loss since 2019. Joining us now to discuss further is Keshav Lohiya, Oilytics CEO. Keshav, for so long we have been talking about what will happen to oil when Chinese demand comes back, when that economy reopens. It's finally happening, and yet the response from the oil market is frankly not one of excitement. How should we be viewing the China story as it relates to oil?
Yeah, thank you, Kelly, for having me. This last week, the biggest news was the Chinese reopening, but the oil market is under relentless bearishness right now. So the oil market is stuck in a rock and a hard place. We have relentless short-term bearish pressure versus long-term structural bullishness. This Chinese news, the consensus was that it's going to be a big reopening trade, but in reality, the reopening is not going to be smooth at all. And the cases, the numbers that we are seeing, the reports of multi-million cases a day is very frightening. And what we are seeing is that, US, Japan, South Korea, Italy have put restrictions on Chinese inbound arrivals. It's a bit of a deja vu of what we saw this time 3 years ago. It's not going to be a smooth reopening, to put it mildly.
Keshav, how much of this is a question of participation in the market? Is there a hesitancy to actively trade commodities right now from macro portfolio managers, perhaps leading to the downfall in oil right now?
Yeah, so it's an interesting point. We are on a holiday period, and I think that there are four main factors right now which will move the oil markets for the next few months, which is basically China, Russia, macro, and basically liquidity. The liquidity weakness, it shouldn't have an impact on the direction of the oil price, but it is spooking a lot of the investors out there, and we can see irrational market movements which are hard to explain. And the lack of liquidity has been a big head scratcher amongst many market participants. But one of the reasons why is that the cost of trading, whether it's higher margin requirements and also with higher interest rates, the cost to hold one futures has now just gone dramatically higher versus this time last year. So, it's just reducing the liquidity of all commodity markets.
Yeah. Keshav, the big story in 2022 has actually been in the product market. We've seen crude oscillating a little bit, but we've seen huge issues in diesel. We've seen huge issues in jet fuel in particular. How does what is happening in China right now, do you think, affect the product market?
Yeah, so on a rational basis, this reopening will boost demand for Chinese jet, for Chinese diesel, any kind of road fuel. And few months ago, China was the only region in the world which was sitting on surplus refinery capacity. They've ramped up refinery runs, and even now the margins are fairly good. Diesel's in a very structurally, the cracks have come off, but diesel is still in a very strong market. So the rational thing for China to do is to boost refinery runs and also increase their product exports. And diesel markets are structurally tight, and China is the only solver which can calm the diesel markets. But the diesel tightness is a structural story which will continue in 2023.
How volatile do you think the jet market's going to be, though? European airlines are down today. The knee-jerk reaction is that we're going to see more COVID checks. The fear is that it extends further. How easy is it to predict what that market is going to look like?
Obviously, the short-termness is going to be very tricky. But, I think despite what happens in China, the jet markets in the West are normalizing. It's now a matter of what... I think the jet markets are only going to get, the demand is going to increase. And even in China, even though we're seeing headlines of these international countries like US and Japan putting extra precautions on Chinese visitors, we should see a boost in Chinese domestic tourism or Chinese domestic flights, which is the bulk of Chinese jet demand. So, ignoring all the other headline noises out there, the jet demand should recover and be on path to the 2019 or the pre-COVID world.
Well, Keshav, let's go from Asia to Europe then. And the idea here that there have been sanctions and price caps really meant to hurt Russian oil supplies and oil production right now. How effective has that strategy been? And have we seen the end of the fallout?
Yeah, so 2022 was not a great year to see the real impact of Russian sanctions because a lot of these deadlines were end of the year, like, in Q4. And the actual flows will be seen in Q1 or Q2 because it's a huge logistical challenge from diverting Russian crude from Europe to Asia. Currently, Russian oil production has been very resilient. And never underestimate the human ingenuity or traders when there is enough arbitrage out there. And that's something the oil markets have been perplexed by because a lot of rerouting of oil flows have happened. But there is a point where all the sanctions snowballing will have an impact on production. And even Russia's Novak has put a headline out saying 500 to 700 KBD of production might be shut down, or refinery runs in Russia could be reduced to allow further crude exports. So the real flows we're going to see in Q1, Q2, the problem is the oil markets are a bit entering a complacency phase. We can't, the real issues we're going to see in the next few months of actual outages.
Keshav, we're going to leave it there. Really useful point to leave it on. Thank you very much indeed. Watch the next few months. Keshav Lohiya of Oilytics, thank you very much indeed. Coming up, we're going to hear from former Ambassador Peter Westmacott on the ongoing labour strife here in the UK. That's next. This is Bloomberg. This is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London. Kriti Gupta is in New York. Anna Edwards is off today. Kailey Leinz joining Matt Miller for Surveillance in the next hour. I hear Lisa's in today as well. Should be a great show. Now, this year, Kriti, the UK economy has been hit by a wave of strikes, from nursing to rail workers. And Peter Westmacott, a former ambassador who now is the chair of TKO Capital UK, spoke about the disruption from these strikes on Bloomberg's Balance of Power.
I think in the UK, it's not about seriously bad weather. It's much more to do with strike action. And we've got a lot of critical sectors where people have just decided They've had enough and they want a proper pay rise. We have 10% inflation, and an awful lot of the salaried middle classes and less well-paid people have had stagnant income since the global financial crisis of 2008. And while interest rates were low and inflation was low, people could just about live with that. But now all those things are changing and people are saying that's not enough. So we've got ambulance drivers, nurses, railway workers, baggage handlers, immigration control officers at the airport. We've got a whole lot of different people who are now saying that they want a better pay deal, please. And the government at the moment is saying either it's not our responsibility to negotiate pay deals, or it's saying we have to hold firm because the country can't afford, after all the money we've had to shell out in dealing with everything from COVID to pension funds, which we're getting into difficulty. This is not the moment to allow pay increases that the country can't afford. So there's a standoff at the moment. And the result is that over the very difficult Christmas holiday period, an awful lot of people's travel plans have been seriously disrupted.
Sir Peter, if we go back a few years, there were representations made, I believe, that in fact the British economy would be stronger, be able to deal with things like this better if it just came out of the European Union. I wonder if people are starting to have second thoughts about that.
Well, I think you wonder right, David. Some of us who thought that leaving the European Union, and particularly the single market and the customs union, was not a good idea for the United Kingdom, we got shouted down by those people and sometimes interrupted on live radio and television by people who said, you're just thinking about the economy, what about sovereignty, what about asserting our control and not being ruled by unelected officials in Brussels, and all that sort of stuff. And why should we accept regulation set by the European institutions? Well, they did not really promise a more prosperous existence, though some people did. The Brexit advocates said there will be no loss of economic prosperity, prices of food and everything else will come down, we'll be just as well off, if not better, in the future. But the real problem, I think, is that back in the days of the 2016 referendum, the economic issues that some of us highlighted were not given sufficient attention. It was about politics, it was about sovereignty, and it was about keeping the Conservative Party of the United Kingdom united. That was the forlorn hope of Prime Minister David Cameron. But fast forward now 6 years, David, and what we've got is public opinion which was 52-48 in favor of leaving the European Union in that referendum is now something like 56-44, thinking it was not such a good idea and that it isn't worth the price and that many of the promised benefits simply are not there. And that is, of course, true. Small businesses, exporters, the hospitality sector, anyone in the services industry who needs the manpower that came from having freedom of labor with the rest of the European Union is finding it really, really hard to find the skilled manpower that they need to make things function. And so trade is down, employment is tight, salaries are having to rise. It is a problem. And I think there's a growing realization that people were, I don't want to show my own prejudice, that they were sold a pup with the idea that the country was going to do better outside the European Union rather than staying inside it.
That was, of course, Peter Westmacott, chair of TKO Capital, speaking on Bloomberg Balance of Power. It's interesting, the new incoming leader of the TUC, the Trade Union Congress in this country, talking about the fact that the government basically is now standing in the way of getting a deal done. And we are going to see pretty ongoing strikes in the new year. In fact, it looks like they are going to be amped up as we go into 2023.
You know, I think it's interesting from a more American perspective, from a global perspective, this idea of the ripple effects here, because you're starting to see this same dynamic across the world in various parts of Europe, but of course here in the States as well. And I have to wonder how much COVID now will play into that story even more.
Absolutely. It remains a factor. It's interesting, the Italian Prime Minister Giorgia Meloni saying within the last few minutes that COVID testing not effective unless it's EU-wide. Italy has decided to impose fresh COVID testing on Chinese arrivals. We'll see how the EU reacts. Are we going to get a decision today? There's a meeting in Brussels, Kriti.
Yeah, certainly a deja vu to some extent of 2020. That does it for Early Edition. Surveillance is ahead. Lisa Bromwitz, Matt Miller, and Kailey Leinz co-hosting today. We're going to hear from a standout guest list. Stick with us. This is Bloomberg.